The 2007-2008 global financial crisis, explained simply. The 2007-2008 financial crisis, also known as the global financial crisis, was one of the most serious economic meltdowns in modern history. It began in the United States when the housing bubble burst. Home prices collapsed, banks faced enormous risks, and all the financial assets tied to U.S. real estate suddenly lost their value. This triggered a worldwide chain reaction. Global financial institutions suffered huge losses. Lehman Brothers filed for bankruptcy on September 15, 2008, and major banks around the world fell into crisis. What followed was the Great Recession, the deepest global downturn since the Great Depression. Soon after, smaller crises erupted elsewhere. Greece's debt problems in 2009 grew into the European debt crisis, and Iceland's entire banking system collapsed between 2008 and 2011. How it all started: the mortgage bubble. In the U.S., the mortgage market was enormous, about $10 trillion in size, the largest financial market in the world. Originally, most home loans were prime mortgages, given to borrowers with solid credit histories. But over time, banks began lending to riskier clients. These became known as subprime mortgages, which grew to $1.5 trillion by mid-2008. Low interest rates made borrowing look easy and safe, and many low-income families took out adjustable-rate loans. When the Federal Reserve started raising interest rates, monthly payments went up, and home prices began to fall. Suddenly, millions of Americans couldn't pay their mortgages. The U.S. economy, which had been relying heavily on rising real estate prices, began to unravel. The role of financial engineering. As home prices rose, people felt richer and borrowed more, fueling consumption and speculation. Banks and financial firms turned these mortgages into complex financial products known as derivatives. Through mechanisms like hedge funds and mortgage-backed securities, banks were able to transfer their risks to other investors. But this also meant that global banks became deeply interconnected. If one fell, others could too. Lehman Brothers was at the center of this system. The collapse. Even though warning signs appeared in 2007, stock prices of financial institutions stayed high, so investors didn't panic. Most bankers believed the issue was just a temporary liquidity problem. But by 2008, the web of financial exposure had grown too large to control. When home prices collapsed, losses spread everywhere. Bear Stearns, a major investment bank that didn't even specialize in mortgages, went under because of its mortgage-related investments. On March 16, 2008, the Federal Reserve helped arrange its sale to J.P. Morgan Chase to prevent a total collapse. That event shook confidence across Wall Street, and all eyes turned to Lehman Brothers. Lehman Brothers, the breaking point. Lehman Brothers had become the biggest hub for subprime mortgage assets. To hide its growing losses, the company used an accounting trick called Repo 105, temporarily removing liabilities from its balance sheet to appear profitable. Despite the cover-up, trust evaporated. When Bear Stearns fell, panic spread. Lehman's CEO, Richard Fuld, refused to sell or merge the company, hoping to survive the storm. But by September 15, 2008, Lehman Brothers declared bankruptcy with $639 billion in assets, marking the largest bankruptcy in U.S. history. That same day, Merrill Lynch was taken over by Bank of America, and the financial world went into chaos. Government intervention. By August, U.S. officials were already alarmed by the plummeting stock prices of Fannie Mae and Freddie Mac, two major government-backed mortgage firms. When promises of government support failed to restore confidence, the Treasury announced on September 7th that both companies would be nationalized. Soon after, Treasury Secretary Henry Paulson unveiled a $700 billion bailout plan. The U.S. government would buy toxic assets from banks to stabilize the system. The credit rating scandal. The crisis also revealed a serious flaw in the financial system: the credit rating agencies. These firms were supposed to warn investors about risk, but instead, they fueled the disaster. Even just 6 days before Lehman's collapse, Standard & Poor's still rated it A, one of the highest grades. Moody's didn't downgrade Lehman's rating until literally the day before the bankruptcy. These agencies were meant to protect investors with honest and transparent information. Instead, they stayed silent, hoping Lehman would find a buyer. Critics, including Chinese officials, accused them of being politically and ideologically biased, and the crisis proved those accusations weren't unfounded. In short, the 2008 financial crisis wasn't just about bad loans. It was about greed, denial, and misplaced trust. A system built on confidence and credit lost its credibility overnight,